So here's the formal definition, and technical analysis is based upon the idea that market action discounts the future. Somebody's going to do those discounted cash flow models. Not me, someone else. And we're going to let them do it all they want because they're going to create trends. So while they're busy doing their models that have no real value to many people, they're going to create trends, and we're going to trade those trends as they unfold. They unfold because history repeats itself in a general manner. And if we look at market history, as soon as individuals began trading in the 1600s, they created a bubble in tulips. So the flower became a bubble because they decided the flower was worth X dollars. And they kept bidding it up until nobody could afford flowers anymore. And then it crashed. So that was the 1600s. People began trading. They began subdividing tulip bulbs into futures contracts. They created a real mess, but it was driven by greed. They thought the flower was going to be worth more tomorrow than today, so they bought. So eventually you got a bubble, and then you got a crash. We saw the exact same thing in the 1990s with internet stocks. We went from internet stocks being novelties to analysts saying the PE ratio isn't price to earnings because the internet is changing everything. PE stands for price to eyeballs, because if you get enough eyeballs on a website, eventually you're going to make money. So we justified it with a new way of thinking. And everybody bought into that. We had a bubble and then a crash. So we have that greed to fear cycle play out. Right now in the US markets, we're seeing it in marijuana stocks, where marijuana is going to be legal everywhere, and everybody's going to smoke marijuana or whatever they do with it. And the greed is starting to set in, because how could marijuana not be a great market? Well, if you look at marijuana stocks, you see a lot of volatility. Volatility is good for trading, but we're seeing that exact same thing play out again. So history does repeat in a general manner. Bubbles, in particular, repeat in a general manner. And it's all because human behavior is a little bit consistent over time and across cultures. No matter where you live in the world, you see greed and you see fear. And you see it in elections, you see it in the economy, you see it in the stock market. So as long as we have these factors going, as long as humans experience greed in particular, as long as humans continue to make the same mistakes they have in the past, prices are going to move in trends. And we're going to be able to trade that based on technicals rather than needing to know the fundamentals. Fundamentals are priced in because somebody cares about them. But unless you have inside information, you can't make money on the fundamentals. So in general terms, what a technical analyst does is study charts, indicators, relative strength. So let's say that we look at marijuana stocks right now, and we buy into the idea that everybody's going to smoke marijuana and all the companies are going to make money. We want to find the best investment in that group. And then the idea of cycles does factor in, as we saw with that Walmart data. If you remember the Walmart data, we had huge spikes in sales and huge declines. So 6 months before that spike, we're seeing the company's stocks start factoring that in. Investors know when these cycles are going to turn. So if it's in the retail sector, you probably want to be buying the stock in the summertime, anticipating a good retail season at the end of the year during holiday buying. And then you want to sell into that end of year rally as the latecomers come into the market. So you tend to see the same cycles over and over again, kind of a smart money compared to not so smart money. with the smart money understanding nothing lasts forever. So auto sales have a seasonal cycle. Grain prices have a strong seasonal cycle, obviously. And all of these can be broken down into tradable strategies. When fundamental analysts look at a stock, they do incorporate price into many of their indicators. What we're saying from a technical perspective is let's ignore earnings, sales, book value, cash flow. Let's focus solely on the price component of the PE ratio. Because basically that's what it all comes down to. When we're trading a stock, we're not trading its earnings per se. We're trading its price. We're buying when the price is low, not when earnings are low. So by isolating on that price factor, we increase our odds of getting better than average performance. If we look at fundamentals, which we can, in theory, this is the dividend yield in the middle of the chart. So as the price falls here, the stock becomes more value-oriented. So the higher the dividend yield, the higher the value in the stock. So as the stock is falling, in theory, you should be buying if you're a value investor. What I added at the bottom of the chart is just a simple MACD indicator. And it's saying the problem for a value investor is when do you buy? When has this line gone up enough? So MACD at the bottom tells us momentum. And I use this indicator just because it flips from red to green and green to red. Green being a buy signal, red being a stop or sell signal. And as you see, it gave a buy signal very close to the bottom. I don't think you're ever going to have enough information from just a fundamental data series. I think you need this momentum idea, because the example that's often used is if you're in your kitchen and you're cooking and you drop the knife. If you try to catch the knife before it hits the floor, chances are you're going to catch the blade and cut your hand. That's what you're doing as the stock is falling. You're trying to catch a falling knife. One time out of 100, you're going to grab that handle, go right back to cutting, and look really cool for the YouTube video. That's this bar. Any of these bars, you're risking the knife severing an artery. And there's no guarantee a stock or a bond will ever stop falling. And since there's no guarantee of that, momentum can be a really useful indicator. So if you want to use fundamentals, that's great. Use it with the momentum tool. The combination can be more powerful than one or the other. So the assumptions of technical analysis are pretty simple in that it's all about supply and demand. Supply and demand is that basic economic law. And if supply is greater than demand, prices will fall. If demand is greater than supply, prices will rise. We see that in everything. So of course it makes sense that it should be in the market. The efficient market hypothesis, another business school type topic, says prices discount everything. In other words, everything that's known about the price is factored into it already. And that does make some sense. If we're looking at a currency, you have the little traders trying to buy and sell the currency with great leverage. They're going to lose all their money very quickly because there's smarter players in the market. And the smarter players in the market are trying to obviously make money. They're discounting everything. They know everything. It's impossible for any one person to know everything. But collectively as a group, and the group in theory being smarter than any one individual, so the correct price is the one it's trading at right now. Prices move in trends, and we see this a lot. Prices move in trends largely because of just demographic or economic trends. In Japan, the market has been basically, stocks have been in a bear market since 1989. And the demographics of the country have been contracting over that time. If there's fewer consumers, we would expect a long-term downtrend simply because demand is falling. So if demand in the economy is falling because the population is falling, we should see a long-term trend. Within that trend, the long-term trend, there's going to be various other trends. This is why it's possible to make money in one time frame while a trend exists in the other time frame. So even though Japan has been declining now for 40 years or 30 years, whatever it is, there have been upturns, and you can trade those upturns. It's depending on your time frame. If you're looking to be just a scalper, you're trying to make a quarter point move, you really don't care about the multi-year trend. You're focused on just your part of the market. As we talked about, history repeats and emotions drive decisions. I think the important part about the emotions driving decisions is that we have to remember we don't make decisions in a vacuum. We've already made previous decisions that bring us to here. So, for example, if I bought a stock at $100 and it falls to $90, I've suffered through a $10 loss. When it gets back up to $100, chances are I'm going to sell because I got even. And there's a paper written by a Nobel Prize winner calling that get-evenitis. Investors love to get even. So if it goes down, when they have the chance to get even, they're going to take it. There's no reason to sell at 100 except that the previous decision dictated that. And that's what we're going to be looking for in a chart. Support and resistance. The paper also talks about loss aversion and big words like that. It does come down to get-evenitis. And think about how many times you've bought something and suffered a loss. And you often hear investors become very religious when they have a loss. Dear God, let me get even and I'll sell and I'll never do this again. And then they get even and they sell. And then they forget their deity and they do it again. And it's just this thing that plays out over and over again. That's what we want to benefit from, is knowing other investors are irrational. And we don't want to be irrational, right? Nobody here wants to be irrational, but we have been. So if we project that onto others, that's what explains chart patterns. I know there's no charts yet. We will get to them. Because technical analysis is based on this emotional idea, that means it can apply to almost any market. These are the requirements to apply it from an academic perspective. Basically, the market has to be free from price manipulation. And it doesn't have to be completely free. The Chinese stock market does not appear to be completely free from price manipulation. The Chinese government does at times appear to intervene. Japanese government also appears to intervene in certain markets at certain times. That doesn't mean they're completely untradeable, because there is an element of free market capitalism at work there. It does have to be liquid. Some analysts try to apply principles of technical analysis and even fundamental analysis to the housing markets. They're not really liquid. If I decide to sell a house today, it's going to take me a couple months to actually sell it. So charts don't give me much insight into that. In order for these principles to apply, I should be able to buy or sell within a reasonable amount of time. The reason market data has to be available is because I need someone else to be analyzing the chart. This can be hard to admit, but we're going to be wrong quite a bit in our trading. We need somebody else on the other side of our trade, so we need widely available data. There's a great book by Ned Davis Research. The title is, Would You Rather Be Right or Would You Rather Make Money? And that really applies to trading. You can be profitable as a trader if you're right about 40% of the time. But are you comfortable being wrong 60% of the time? For most people, the answer is no, I don't want to be wrong 60% of the time. But if you look at the great hedge funds, many of them admit they're wrong 60% of the time. Paul Tudor Jones, for Americans, he owns the Boston Red Sox. His strategy is right 40% of the time in a good year. He's usually in the 30s. He had $600 million available to buy a baseball team, being wrong 60% of the time. So, would you rather be right or would you rather make money is a valid question to ask. And then the idea of fungibility is also important from a technical perspective.